Welcome back. Angel One is the company that we have on our radar. A market, one of the sort of top market leaders as far as broking is concerned. Dinesh Thakkar is chairman and managing director of the company. Is with us. Mr. Thakkar, good morning. Great to have you with us here. Thank you for your time. Prashant this side. And congratulations on a good set of numbers. I want to start by, we'll get to numbers and what you reported in a bit. But I think you would agree the bigger sort of talking point around what to do with Angel One for investors is, potential regulations. There is, of course, this directive which SEBI sent to exchanges and, market infrastructure institutions to discontinue the practice of charging turnover-linked slab-wise fee structure and make it uniform transaction charges instead. That is one. The second is if there are these, measures like increasing the lot size on the F&O side, and a few others which we've reported as well, if they come through. What are we looking at, Mr. Thakkar, in terms of impact on volumes, impact on business?
See, first of all, I feel all this regulation, whatever comes, it is good for investors. So that way, it is not very concerning for an industry growth. So let us talk about true to label directive of SEBI. They want to be like a flat charge for all brokers. So no discount to be available for volume that we give on the exchange. So that will have an impact of around 8% on our gross turnover. But we believe we have enough levers which we can use to offset that kind of thing, because lots of services today is subsidized because we were getting this benefit. So in absence of this benefit, definitely we have to work out on our unit-wise cost. And based on that, whichever area we were subsidizing, we have to look how we can charge so that we are able to offset this impact.
Okay.
Second, coming on lot side.
Sorry. I'll just come to the F&O side in just a bit. So you're saying 8% impact, earnings impact?
8% impact on our gross turnover.
On your gross turnover because of the true to label directive, right?
Right.
But you're saying all of it can be negated. You'll be able to, or some of it. I mean, and what can you do to do that?
Yeah, so there are lots of levers. As I said, that today we don't charge on lots of services like cash delivery, which is subsidized because we have lots of saving because of this other income. We don't charge on collateral that we receive for our F&O segment. So there are lots of levers we can use, including increasing price for orders and all that. So I see there is lots of elasticity in terms of pricing that we have offered in the market. This pricing is because lots of other income that we are getting. If that stream stops, we have to relook at our business model and relook at our cost structure per unit wise and have a markup on each and every service that we provide. So we are very confident there is lots of elasticity in our prices, and customer would not mind paying a bit price higher than what they are paying today. And that will be enough for us to offset this impact.
Okay, all right. Hi, good morning, Dinesh, and thanks a lot for joining in. The rough number that you get, FY24, from this transaction and depository charges should be around 450 crores. And as you said, around 8% of gross turnover. So that fits in perfectly well. I'm reading a couple of sales notes which indicated you have two levers. One is increasing the charge on orders by close to 3 rupees. I think last year you did around 140 crore orders. So if you just increase it by 3 rupees, you'll make up all of these revenues. Is that an option that you're considering? And the second part is, I don't think you charge account opening charge, which some of your peers charge around 200 rupees. Could you push that through as well?
So that is what I'm saying, that we will relook at the whole business model, whichever areas we are subsidizing. It can be introducing KYC charge. It can be charging for cash segment. It can be looking at our order price that we have put. We can increase that also. So overall, what we are waiting for furthermore announcement from SEBI on changes in lot size and all that. So it is better that we take a decision after all that announcements are there in place, because anyway, this change in true to label pricing and all that will be effective from 1st of October. So we have enough time to relook at our model and work out a pricing which offsets all this impact, which is already been announced, and few which are going to be announced.
You know, and we are expecting, that's the talk that these, on the F&O side, things should come in now. I mean, it should be fairly fast with industry consultation, etc. So what is the, and you will then, of course, respond in a comprehensive way in terms of trying to do what you can with your levers to protect any, sort of limit any earnings impact. So F&O lot size increase, one expiry per exchange per week. These are some of the recommendations, right? Some changes on the number of strikes available, etc. as well on the option side. So just which of these, I mean, if these, what has been reported and what is in the public domain, what is the, I mean, can you give us a sense of what is the impact, what the impact is prima facie? And then you will, of course, try to mitigate the impact through your levers, but that's another story. But if these, what is reported comes through, what's the sense?
Hey, Prashant, broadly, if you look at data, one is anecdotal evidences where we feel that people are over leveraging and all that. But if you look at data since FY18, that is where I think concerns are that from FY18, we saw a huge surge in F&O volume. But if I take future notional value and premium value of option, for all these years, we have seen a CAGR of 11%. And cash market has seen a CAGR of around 16%. So if you look at customer base, that has gone up by around 10x. So if you look at exposure per customer has not increased. This surge in volume in option, which appears to be very kind of phenomenal, it is due to under-penetration that we had in India. Now people have got access to market. So I believe regulator and everybody would consider that and take steps which will be reasonable. We are not expecting very kind of like harsh steps which we are expecting. I think we have, as I said, we have enough levers which can offset that impact. But if you look at customer behavior, they have certain wallet share for trading activity, for investment, for all other activity. So this wallet share is not going to decrease. Only they will defer their exposure in market. Suppose if they are doing 20 trade for them to understand and come to cash market, which was done previously in 6 months, they will do in 9 months. So we believe in terms of business model, our main cost is cost of acquisition. And what we monitor is cost of acquisition to lifetime value. Lifetime value of customer that he engages in this exchange, trading and investment is not going to change. So overall, I don't see our business model going to be impacted in a big way.
Okay. All right. Mr. Thakkar, we leave it at that. Thank you for explaining that to us. Appreciate your time here on CNBC TV18. That's Angel One with their view. But let's